Welcome to the latest episode of Quest for Twice. Today, I'm going to review the latest quarterly performance from Energy Transfer and IEC Electronics. Just a reminder, Energy Transfer has a fairly balanced EBITDA sources from several different segments. The natural gas segment usually contributes to about 40% of its annual EBITDA, and the NGL contributes about 25%, and crude oil contributes about 23%, and the rest usually comes from joint venture with Sonoco and USA Compression Services. In this context, it's very interesting that Energy Transfer made a lot of money from its natural gas segment in the Q1 of 2021. That's due to the non-recurring EBITDA of $2.2 billion from the quarterly ice storm. The $2.2 billion is almost half of its total reported quarterly EBITDA. The reason it made so much money in Q1 from natural gas was because of the very high natural gas wholesale price during the ice storm. So Energy Transfer sold a lot of natural gas from its storage facilities at a very high price. If we look at its main business of transportation of hydrocarbon, its Q1 volume actually was down or flat in most of the segments. The natural gas transportation volume was down about 10%. That's about the same as Q4 of last year. As I mentioned, its EBITDA was distorted by the huge windfall profit from selling during the ice storm. Its NGL volume increased slightly from 1 year ago, and its EBITDA decreased by about 2%. So that's broadly in line as its Q4 performance in last year. And its crude oil segment volume declined by 21%. That's actually a little worse than the Q4 volume transported. But its EBITDA declined by 14%. That's actually better than the 24% decline from Q4. And its joint venture EBITDA declined by about 18% from 1 year ago. So overall, if we stripped out the windfall from the ice storm, it's a business is worse than 1 year ago. However, because of the windfall profit, its total quarterly EBITDA increased by about 90% from 1 year ago. Given the current oil and gas price recovery from the severe downturn in 2020, the activities are actually recovering. So I believe the volume transportation in Q1 will start to recover in the rest of the 2021 and also into 2022 and beyond. And so let's look at the key financial metrics. And it's helpful to compare Energy Transfer with Kinder Morgan. So Energy Transfer's EBITDA is about 10.9 billion forecasted in 2021 if we do not count the contribution of 2.2 billion from the one-time windfall from the ice storm. So that's about 50% more than the quote-unquote normal Kinder Morgan EBITDA of $7 billion. As a reminder that Kinder Morgan is forecasted to have a 7.6 billion EBITDA in 2021. It's also due to the one-time non-recurring benefit from the ice storm. So I think a normal Kinder Morgan EBITDA is about $7 billion. Energy Transfer pay down its debt in Q1 because of the actual cash from the windfall. So now it's a little over 50% more debt than Kinder Morgan. So what's interesting is since its EBITDA is 50% higher than Kinder Morgan and debt is also higher than Kinder Morgan, then the market cap one would imagine would be higher than Kinder Morgan, but it's actually significantly less than Kinder Morgan at about 25 billion compared to 38 billion for Kinder Morgan. So that's why the EV over EBITDA ratio using the normalized EBITDA for Kinder Morgan is almost 10, and Energy Transfer is about 6.6. So the conclusion is that Energy Transfer's unit price is significantly undervalued. And one can argue that Kinder Morgan has more revenue and profit from natural gas, which has a longer runway than crude oil. However, even with that adjustment, Energy Transfer's EV over EBITDA ratio should still be significantly higher than 6.6. Another way to look at it is look at the cash flow. So for 2021, Energy Transfer's distributable cash flow is forecasted to be 84 billion, compared to 5.2 billion from Kinder Morgan. And its 2021 capex plan is 1.6 billion, and the dividend is also about 1.6. So putting those two together, that's 3.2. And that'll, if we subtract 3.2 from 8.4, then that's over $5 billion left can be used to pay down debt. So I believe Energy Transfer will pay down debt quickly after it reaches a comfortable debt to EBITDA ratio of 4 to 4.5. Then Energy Transfer can use the excessive cash to buy back units or increase the dividend. So compared to Kinder Morgan, Kinder Morgan's free cash flow after paying for the capex and dividend will be less than Energy Transfer. So the upside for Kinder Morgan is more limited compared to Energy Transfer. So in conclusion, Energy Transfer is a significantly better investment option compared to Kinder Morgan at the current stock price. IEC Electronics also reported its quarterly earnings. Its Q2 21 revenue is about $45.4 million compared to $47.5 million in Q1. And that's a growth about 3% compared to 1 year ago. That's a slowdown from 22% annual rate in the last 4 years. And for 2020 over 2019, the revenue growth was 16%. So I would say the revenue growth result was very disappointing. And according to the management, the disappointing result was due to the delayed ramping in 2 high-value programs. And those issues have been fixed, according to the management. Just a reminder, IEC also reported the disappointing Q1 growth rate. And the management blamed that disappointment on COVID-related employee absentees. So both quarters' disappointing results were related to poor execution. However, management restated that they are very confident the annual growth will be about double digit compared to 1 year ago. So that implies the Q3 and Q4 revenue in this year will grow about 20% or more compared to 1 year ago. So I would say the growth trajectory is still on track. So maybe it's on pause, but I would like to give IEC more time to prove itself. The reason being that I believe its physical growth plan is on track with $27 million invested in new office and facilities. And IEC is in the middle of the move into new facilities. So hopefully with the new facilities, the revenue will catch up to match the increased production capacities. And the management also gave a guidance on the capex in 2022 as in its normal capital expenditure range. So my estimate of that is about $4 million. So hopefully IEC revenue growth will recover in the second half of its fiscal year 2021 and will continue to grow to match its increased production capacity. As a result, I'm still hopeful with the IEC's growth prospect and will continue to hold my stock. So that's all for this episode of Quest for Twice. Until next time, happy investing.